Hello everybody, it's me the Boss Hog, and today we're going to look at my portfolio as of the week ending the 4th of March. Currently stands at 90,000, and if you're paying attention you might notice that's quite a big fall from last week, and you'd be absolutely right. Let's see why. Alright, so yeah, this isn't clickbait. My first ever five-figure loss in a week. Unrealised, to be fair. But yeah, my worst week ever by some margin. I haven't even got a week that's particularly close to this. As has been happening for the last week, a couple of weeks as well, I've been listing my Russian exposure separately, and my two holdings were down a further 4,000 odd between them, so that's pretty nasty. Poly has especially been quite painful. It's fallen quite significantly, and it was meant to be my gold hedge as well, so that definitely hasn't worked as expected. Just trying to work through at the moment. I would say outside of my Russian shares this week, my UK rest of my shares fell more or less in line with the market, which actually I was relatively pleased with because I'm quite light. I mean, I have no exposure to like oil or gas. Where at least in the wider FTSE, there's the likes of BP and Shell that are going to kind of support that. And likewise as well, I don't have any exposure to defence stocks, which right now is a poor place to not have any exposure to. So to be fair, from that perspective, it's okay. My US stocks, though, underperformed what was more or less flat. But again, I have a heavy-ish tech weighting here as well. So again, that was part of the reason for that, I suppose. So quite painful. I would say that, I mean, I commented on this a couple of weeks ago. I've got to the point where I'm relatively like sanguine about all this, and I was curious if I'd stay sanguine when I'm now actually down since I started investing. Right, for the last couple of weeks, I've been basically eating through my profits, but I'm down sort of about 25k in a month, which is significant considering that my portfolio, at its peak was just about 110, so I guess maybe down more like 20,000, but still, significant fall in just over what's a rolling month. So that's been quite painful. At the same time, though, like I have been talking in Discord about the fact that I'd really love a buying opportunity. I've only been in the market for about 15 months, so I've never seen this beforehand. I wasn't in when it crashed after the first lockdown. I'm actually hoping it stays this way for another month because in early April, the UK's tax year restarts, and ultimately I'll be able to add a bit more capital and basically try and take advantage of some of these shares I've been buying even more so. Now, this week I actually wasn't going to add any money at all. Partly that's because I have a job where I'm very busy the first week of the month. And if I'm honest, as much as I'm sort of sanguine about it, it was hardly like I was logging into my investing account every day, right? There's only so much red you can see before you're like, oh, Christ, I'm just going to give that a miss. However, on Friday, I saw that Games Workshop especially was under £70. For me, that's a good value buy. So I put in 250 here just to buy 4 shares. So that felt pretty good, or just under 4, maybe it was 3 shares, sorry. But yeah, so I put in a couple of hundred here. I don't think I'm going to be adding a ton of capital over March. We had a VAT bill, or a tax bill actually, sorry, an income tax bill that we needed to settle from the taxman. So that was about 4k. And to be honest with you, anything spare, I'm kind of just tempted to let drift into April just so I can put it into our tax efficient accounts as well. But still, that said, I felt like this was I wanted to put some money in and buy those shares. So this week again was another heavy trading week. To be honest, that wasn't the plan. I did almost all of my trading on Friday when I just looked at the UK market and I felt like there was a combination of either some good growth opportunities, sort of companies that fit my plan this year of kind of being more high variance, which I guess we're definitely being. As well as some opportunities in the financial sector in the UK. I'll talk more about that in a second. But yeah, for me, I'm actually happy with my moves. I sort of abandoned one of my last remaining safe havens, but put it into companies that I think are really great value in the long run. So I'm actually quite happy with my trading. And last but not least, I got what's a quarterly dividend through from Games Workshop. It's relatively rare in the UK to have a quarterly dividend, but Games Workshop do. And I was quite happy with the amount I received here. And again, so I got more than a whole share of Games Workshop on the quarter, so that felt really good. And I just put it back into Games Workshop, so no excitement there. And Macerich here was a REIT I had a couple of weeks ago, my final dividend for them. I wouldn't say that Macerich is a traditional REIT. Of course, sorry, by that I mean when you invest in REITs, you're kind of buying into that sort of safe, steady, slowish to moderate growth dividend and everything else. Macerich isn't really like that. It was over leveraged when COVID struck, and it's been repairing itself. So I view Macerich more as a value and recovery play in the REIT sphere. So buyer be warned, there are definitely safer plays both with REITs in general as well as more REITs. Simon Property Group would probably be the main one. But still, I think there is value to be had if you have a medium to high risk tolerance in the REIT sphere. Macerich is a good one to look at. Okay, so that's my summary. Obviously, it doesn't look great, but let's have a deep dive into what I've been buying and selling. All right, so first up for me is more of the same regarding bowls. So this used to be my largest holding about 9 months ago, and then I sold down to 2,000 shares. Took some profit at I think it was 274, 272, something like that. Since then, it's had quite the fallback and is now below my average, not by much though, but a couple of percent under. So I've just been buying it, seeing it as an opportunity to add some more shares. So I've now got 4,500 Hollywood Bowl shares, now a top 5 holding for me. I'm really delighted to hear my buy price average of 218. I'm expecting sort of somewhere between about 27 to 35 million pound profit this year. That's based on sort of a combination of history before lockdown, as well as their kind of average spend, and then the additional sites that have been opening as well. So crude calculation, I'm not very slightly above the average of analyst expectations, but I'm happy to put in a ballpark of 30 million here. I think it's a really well-run business that basically took the opportunity to improve itself during lockdown. Last 2 years look pretty bad because it struggled to make any money, but again, considering what we've had for the last 2 years, I think it's remarkable that they were profitable during those years at all. And I think this is a really good business. Yeah, I like everything about it. Basically, branding's good, locations are good, their business plan is good, their sort of dividend strategy, assuming they re-implement what they had before, looks good. And right now, I imagine if they did that on these earnings, you'd be looking at about a 5.5% yield. So that feels really good as well. So I'm basically just using this as a great chance to buy Hollywood Bowl shares. And by the way, I had some feedback, and I guess I'm welcoming more feedback because I'm trying to improve the channel. A few people have asked me to just talk through in a bit more detail, maybe pick on fewer companies, but do it in a bit more detail. So this is my attempt at starting to do that, basically. So there will still be standalone videos. I'd actually like to do one on a few companies at the moment, but just to sort of spend 1 to 2 minutes on just a handful of companies. So I'll try and do that, basically. That's my rationale for Hollywood Bowl. Next up is Fevertree. So this is becoming a real conviction play for me. I was into Fevertree beforehand. I bought at 19 and sold at 24 and a bit. My rationale for doing that was twofold. First of all, I wanted to buy shares in National Express at the time, which for me, again, is a good buying opportunity at the moment, and it was historically as well. And also, Fevertree has quite the, like in my head, and I have got a video on Fevertree as well. It really depends how optimistic you are on their growth in 3 areas, in my opinion. So that's off-trade sales. So specifically, that's trade directly to consumers or via supermarkets rather than through restaurants and bars, which is on-trade. Then there's international sales, and then there's other mixers. So traditionally, this was a gin and tonic mixer, right? Tonic for the gin. Gin, though, is a very UK drink, really. They saturated the market, were a bit slow to maybe go international, but they've been doing that now for the last couple of years. As well as the other mixers. And for me, even though they had some cost headwinds in their latest results, the reason for me investing and actually becoming more optimistic about this company is that all of those numbers were basically running ahead of my and indeed the company's expectations as well. Off-trade is holding up really well. International sales are going great. Mixers, I think the real headline here was that they became the #1 ginger beer product in the US, which is new, wasn't even on their target, as well as replacing Schweppes as the #1 tonic in the US as well, which they did in the UK years ago. By the way, it's such a better product compared to Schweppes. And I'm not really necessarily always an investor who buys things, buy shares in companies that I really love. I don't own any Apple as an example, right? But I'll happily buy shares in there. But I really love this product. I think it's superior to every other thing out there. I love the branding, and as a combination of a good product and good branding, I expect them to be able to manage costs. For me here, a real improvement of the business would be trying to find like a a good CEO, like sorry, CFO, like one of those people who's been in the industry for like 30 years and is well known for maybe their cost management and their streamlining. Every now and then I feel like the company, even though it's a multi-billion pound market cap company now, it's not huge and it's still relatively new, and they just kind of seem a little bit amateurish for a company of their size. And I really think that their board could benefit with kind of like an industry stalwart. Like, it's great the founders are still around, that's cool, but I think it would be really great for everybody to help with that. So that would be a real win for me. But again, I really love the company, the products, the growth, and even though the costs are going to be a challenge, I think it's a challenge that they'll be able to overcome. And to be fair, like I say, the revenue growth here is really doing great. So I'm just following this down, and again here I'm picking up these shares at £17 a share. I think my range of price is still the £21 to £28 that I spoke about in a previous video, depending on how these three levers go, and I'm going to stand by that. I think that's still a good range of pricing guidance, basically. So that's my target here. I'm up to 200 shares again in Fevertree, which is the joint largest position I've ever had in them, and I will be looking to buy again. Anything under 19 for me is a relatively easy buy. Next up, Games Workshop. So again, I have actually two videos on Games Workshop. I really like it. Historically, when I was buying this at like £95 or even a plus 100 per share, it was a case of quality company. Yeah, it's expensive, but quality company, so fine, it's a reasonable price. This is a company that's historically traded on the kind of a 30 to 35 PE. Now though, I actually look at the company, I just think it looks cheap. Like, there's no two ways about it. I feel like okay, it's not like dirt cheap, we're not looking at like Evraz like 0.4 PE at the moment, right? But for a company of this quality and with a lot of growth potential and basically a really strong moat, I think this is really great value. So like, I know like some people look at this and say might be expensive, but you're looking at like a 370 EPS already on what was seen as disappointing earnings. And I actually think that when they next publish their results, I'm kind of hoping for a lot of upside. They had some logistical problems as they expanded. They needed some investments. Maybe they were a bit slow to kind of look at online sales. They've traditionally been relying on their offline sales and real kind of expertise to get people into the hobby. So, like their online journey wasn't particularly good, but, they've updated their rule book, which has been well received as far as I can tell. I think their upcoming law, as in LORE changes, are awesome. And I think although the products, the miniatures are expensive, again, there's clearly a market there that people want to play with and enjoy. And obviously here the licensing of their IP is extensive and has real potential. So that was the standout good point in their last earnings. So as long as they can overcome their logistical problems and their costs, I'm actually looking for like £120 here, which again looks ridiculous. I appreciate this probably sounds silly while I'm buying shares at £69, but that really is only a reflection of sort of a 32 PE and then a little bit of modest growth built in on top of that. So again, I'm really just looking for Games Workshop to get it back to their averages. Yeah, and I'm sort of pretty confident that we will be able to get there. So that's it. In fairness, the dividend yield is now pretty solid. It's like at nearly 3%. So even though the company talks about, they don't really see themselves as a dividend growth company. That isn't how they do it. They talk about truly surplus cash, right? We'll give you it when it's there, when we can't think of anything else to do with it. But still, it's starting to really throw off a lot of cash and dividend. And at these kind of levels, to me, it's just an incredibly easy buy. It's actually in the same portfolio. Sorry, I've got like 3 different investment accounts that make up this 90,000, and it's in one with it's less tax efficient. And I put my sort of high growth but low dividend yield ones in there just because of the tax treatment in the UK is kinder to capital gains rather than dividend, at least to me. I meant to, in this portfolio, I've got things like Microsoft and Apple and a few others that are like that, and I just keep going buying Games Workshop because I just think it's good value. So again, that's my rationale there. And last but not least, I've grouped this together. I could have included Legal and General in this as well, which you'll see there is like the 6th biggest buy this week. But these are FEVR and Aviva. These are FTSE 100 insurers. Aviva is probably more known to people. FEVR isn't. But these are companies that are like yielding 7%. They're good companies. Aviva's been on like a 2-year turnaround that more or less is complete. And if you've channel regular many weeks ago now, like 6 weeks ago, I sold out of Aviva. I had 800 shares. I sold out of 442 odd. And basically I did that because I said, yeah, even though I won't be getting, the dividend or possible capital redistribution from their sold and simplified business model, I'm happy with the turnaround, right? I was in Aviva for a turnaround. I consider it complete at 440. I'm good to call it. Since then, the share price has fallen back to 380 or whatever it was, 390. Yes, I bought this in 2 chunks, but 393 is the average with the stamp duty included in that. And this was a combination of the fact that I thought they had solid results. Does confirm that the turnaround has basically completed, more or less in line with expectations, modestly to the upside, but not very, very much. And actually, I felt like a combination of both their existing dividend yield and then their capital redistribution, which is a little bit fiddly, but will basically mean you'll get something like £1.20 for your shares for each share that you hold, right? Which, considering I'm buying these at like 3.92 at the moment, just to me seems like a real no-brainer. So yeah, that's basically it. So I'm looking to get into Aviva back into Aviva and build a more material stake before I lose rights to that capital distribution in early April. So yeah, I don't think I'll ever end up with a huge stake in Aviva. This was going to be a kind of short to medium term holding. But again, I'm happy to do so and take advantage of that. And again, for me, Aviva is a relatively safe haven at the moment in what's a very choppy market. And last but not least, I decided to increase my holding in Phoenix. I've now got 1,200 shares in total, so this is the largest position I've ever had in Phoenix. I can't believe I'm picking this up under £6, to be honest with you. The dividend yield is 8% at these levels. The company has gone through a transformation over the last couple of years, basically acquiring businesses. Because it was buying those businesses in cash and stock, it ended up with sort of companies having large positions in Phoenix, and then those large companies have gradually sold out. The last 2 have been Swiss Re, the insurance, and Aberdeen, as it's now called, who sold Standard Life to Phoenix. So this is like, pensions management company, basically. And, Swiss Re is now fully sold out. Aberdeen are selling out as well. They still have about a 10% stake. So that's been putting some downward pressure on the share price. But again, this is a company that's very powerful in a niche sphere of kind of like life assurance and general pension planning. And things like funeral and that kind of insurance products as well. So they deal with kind of end of life stuff where the margins have traditionally been quite small. But they are now so big that they're basically able to benefit from economies of scales and compete in a way that almost incentivizes other insurers to just sell their life assurance books to Phoenix. So that's fantastic. And the other reason as well I really like UK insurers at the moment is that historically insurance companies had to keep a significant amount of their capital in reserves. This was part of an EU regulation. Now that the UK has left, the government has announced basically that it's going to reduce these requirements to basically free up money so that insurance companies can invest in things like infrastructure, in housing, etc. I mean, and it was interesting because, as soon as the story broke, you had these 3 companies, Phoenix, Aviva and LGEN, basically saying, we love the idea, right? Because ultimately what it will do is it will increase their return on assets, right? They won't have to keep as much like dead money on the side in readily accessible money. They'll be able to reinvest it in things that, yield or return sort of 10+%. And that should make them better businesses as well. So this is, I guess, a Brexit dividend, if you want to go down that route. And yeah, so I think, honestly, I continue to bang the drum of UK insurers. I think regardless of which of those 3 you go for, and there are others, by the way, in the FTSE 250 as well, there's some good opportunities at the moment in that sphere. So anyway, a bit more detail than I usually go into. Hopefully that was good. And again, I welcome feedback because I feel like I spent a lot longer than I normally would on the shares I bought. But hopefully that was interesting and might give people some ideas. But let's have a look at the sales next. All right, so maybe I'm going to start with the most controversial point here, which is that I basically sold out of almost all of my REITs. I kept one Vicky share just so I can keep an eye on the price, but notably DLR and MPW, which I literally held for a week, and then Realty Income, which I just held for a few weeks. I decided to sell. I've been treating REITs kind of as a little bit of a safe haven and kind of rapidly moving into them, but I just preferred mainly the UK insurers as an alternative. So Vicky went into Phoenix, and then the others went into sort of, Lloyd's, which is a UK national bank, as well as the Aviva and Legal in General there. And to be honest with you, I view them fairly similar. Like they're both like, if I compare that like UK financials versus US REITs, these are relatively safe things that aren't going anywhere. And really, my main point of view here was that although, you know, there's probably some upside to the share price to both of those, it's not huge, but actually it's probably bigger at the moment, in my opinion, at least for the UK insurance, particularly FEVR. But also as well, like they both have like very similar dividends coming up. But the yield is much better for the UK insurers. And again, like I'm very keen at the moment to get some money so that I can average down whilst the market's so red. So and to, like I say, so a combination of like, you know, I'm looking at 7 or 8% yields instead of like 3 to 4% yields for the REITs, and they arguably have similar upside in terms of their capital, right? If I was to compare like Vicky, maybe you have a $35 price, whereas FEVR, you know, I mean, it recently had an upgrade from is it Barenberg, you know, put them at like 800 pence. So again, like the idea here is that maybe they're both 20 to 25% undervalued, but it's pretty close. And I just decided that I preferred the insurers to the REITs. So yeah, I actually ended up doing pretty well considering how short I held these companies for. Modest return actually on Vicky, but a few percent plus a dividend, similar with O, and then just DLR and MPW. I timed the dip last week super well, so actually ended up like a 7% profit on those. So actually, I'm pretty happy with that. I mean, very happy considering the state of my portfolio at the moment to more or less just cut and run. So again, a little bit controversial maybe, but apparently I have no loyalty. HBAN here as well. I've spoken about them before. They had disappointing-ish results, although I think the share price, it was nearly at $18, was too high. I think again, anything sort of in the, you know, under 15 it could be justified as a buy. I just felt like Lloyd's was better value, and I was, like I say, consolidating and tidying things up. So, like I say, it's nothing wrong with HBAN at all, though, at those prices at least. CACI or CACI, they call themselves CACI. It's kind of a niche military company and data company. You know, it doesn't produce hardware; it's more like software and services for like the NSA and stuff. In a way, I view this as a less mean version of Palantir, and it's already profitable and it's been around for a little while. Doesn't pay a dividend, and I wish I had more shares in it because it actually has done really well over the last few weeks. I basically got to my fair price of like $290, $292 actually, and then I sold just to release some money and put it into Games Workshop. So great. And then last but not least, Persimmon. This is a UK house builder. They had solid results. I feel like with Persimmon, you always get solid results. They don't really surprise either way. I think they might be the largest house builder in the UK, but they are reliable, have a big fat yield as well, and are kind of our bellwether kind of company. Yeah, solid results. I had a reasonably large stake in them, right? 1,300 according to this. Their results were in line with expectations, and they rose well enough for me to basically get out at cost. And for me, that was a good opportunity because, again, I just really wanted to free up the money for, again, my financials, and also a little bit of money for Redrow as well, which is the other house builder I have. The reason why I had both is Persimmon is that reliable, not going to do you wrong kind of company. Redrow at the moment is having a turnaround where they move from basically high revenue but lower margin and sales that take a longer time in the southeastern London, and they're basically going up north where, you know, the revenue will probably be under pressure, but actually the earnings and the turnaround will improve. So they'll sell more units, they'll sell them for higher margins, but their revenue will go down. So ultimately they'll become more efficient because their margins will go up. So, you know, I kind of like those companies. I think they often fly under the radar because, you know, people have these ideas about, you know, I should constantly be growing revenue. But actually, you know, when a company goes through these kind of journeys, I think that's one of the few times where there's an opportunity to kind of beat the market. I think that's also what I'm looking at with a company like Amcor at the moment, like sort of semiconductor play. And last year, and now actually my best performing share so far, Huntsman Corporation, very similar, right? That was a company that had gone through these kind of journeys and was moving into higher margin areas and selling out of their lower margin stuff. So great. So I think Redrow is very similar. Persimmon, nothing wrong with that. I know at least one of my viewers has a big stake in it. So hello, Martin. And like I say, there's just nothing wrong with Persimmon. It was just a decision I made to put some money into the financials. I mentioned Legal & General and Aviva, I think are both great buys, and Redrow for the reasons that I've just discussed. So anyway, a bit more detail than usual. I would like feedback because I am trying to do this. So I don't know if the long video is just going to turn people off or whether it's sort of, oh yeah, okay, now Liam's actually giving me some more useful information. So we'll see. But yeah, thank you very much for watching. Hopefully that was interesting. Like I say, a difficult week, but I feel mostly okay. Other than, yeah, I have definitely been checking my portfolio less often, just because I already know, it's going to be pretty ugly when I log in. But actually, I'm really excited about adding money at these kind of levels. I feel like it's the first time I've been buying really great companies cheap, definitely below fair value in my opinion, but cheap in some cases. And actually, I'd really like to be doing it more. I'm still 2 decades away from retirement, so an opportunity right now to put money into it just feels really great, to buy as many shares as I can in good companies. So that's the approach at the moment. Anyway, thank you very much for watching, everyone. I've been the Boss Hog, and good luck for your investing. Bye for now.